Ni hao and hello everyone. My name is Rüdiger Born. I'm an institutional trader since roughly 30 years, actively trading the markets, living in Frankfurt, Germany or Tokyo, Japan. And today I want to introduce you a trading style which is maybe very useful for you. This trading style you can apply to many different markets. You can use this with the indices, for example, the Shanghai index or the Hong Kong index or any other internationally traded index. If you want to, you can apply this for the foreign markets, for example, for the currencies, and of course for single stocks and any other, maybe some commodities as well, if you wish to. Before I introduce you the trading idea and the strategy we were trading, I have to tell you what I'm doing or why I'm doing this. This is a chart technical analysis we do and where we dedicate our trading to. The question is, why chart technique? Isn't it the news that is driving the markets, especially currently with many geopolitical situations, with many informations from companies or countries? What is really driving the market? Of course, the news is driving the market from the idea, but how the traders decide, how the market participants are reacting on all these numbers, this is giving in the charts. And so you can read the charts and see what the market participants are thinking. Are they enthusiastic? Do they really want to buy the market? Or are they restrained, saying, maybe I wait a little bit? Or are they panicking? Everything you can see in the charts, the direct reaction on all of the news, and that's the true value of all the chart technical analysis we do. So I'm looking forward to talk about this with you on the charts, so let's switch to the screen. Before we start with the chart, and I have some really interesting situations on the real current actual charts, before we do that, let's have some theoretical idea behind what we are looking at now. This is something, it is called Elliott wave, and in the Elliott wave idea you have two difficult movements. One is strong into one direction, and you have here one really famous part of this. This is called an impulsive move, or an impulse in this case, which is typically seen in a 5-wave 1, 2, 3, 4, 5-wave move. And you can also see this is in both directions, so you only need to stick with the upper one. The lower one is just for different time scales, but it's roughly the same. You can see the structure is 1, 2, 3, 4, 5 into one direction, and very often you can see on the lower time frame even the same structure is inside any wave. You can see 1, 2, 3, 4, 5, and this is indicating this cycle of movement. The strong movement is over, and we can expect something like a corrective pattern. So this is the main pattern into one direction. We have two others, just to mention it. It is a leading diagonal, which is roughly the same, but you can see sometimes this is even overlapping. So the strength is not very strong. And on the other side, you have an ending diagonal, which is roughly the same. The internal structure is a little bit different, but for today, this is not the super important thing we need to talk about, because the impulse move is the wonderfulest and the best to trade, because this is giving us a fast move, and that's what we really want normally. On the other side, if there's a fast move, we need to see something like a counter move, and this is called a corrective pattern. And you can see the movement, even the strong movement, is very often stopped by some kind of a break here, like a breather in the market, some kind of a pause. You can see an ABC pattern here, for example. You can see an ABC pattern here. And if you use a magnifier glass, you would see here something like an ABC as well. Here it is just a single line, but you can see the straight line to the upside is sometimes broken by these small corrective patterns inside the big picture. So how do they look in real life? We can see this. It is called a zigzag, for example. And the same zigzag, switching back to the impulsive move. Let's check this one, for example. This movement here might look on a magnifier glass exactly like this one. The second here, it is the first move to the downside, a second to the upside, and a third wave to the downside. To simplify things, it is just an ABC pattern, and that's exactly what we have here, an ABC pattern or an ABC pattern. These are typical corrective patterns. It's the easiest way to understand how a corrective pattern is. If you know already about the situation here and the Elliott wave theory, you know this is a fast movement, another impulse, 1, 2, 3, 4, 5, an ABC pattern in between, and a 1, 2, 3, 4, 5 pattern at the very end, all together marking this ABC pattern. We don't need to stress this very deeply, because if you see this in real life, you will clearly understand this is one kind of a corrective pattern. There are even more. Just to name them, for example, a flat pattern, which is also some kind of an ABC pattern, but the big difference is this is way higher than the starting point. It is always also an ABC pattern, but this one is starting way higher. This is, to be honest, the most complicated thing in all the trading strategies, because this is where starters, or let's say some newbies coming new to the market, realize, oh, it might be difficult to trade because this is easily interchangeable, or you may mistakenly use this as a movement you don't want to trade. So for the first, now what we are looking at now today, we want to skip this. This is more for the more professional one. If you already can read these in the real market, then it's good for you. For today, we keep it quite simple and stick with the most common corrective pattern, which is this ABC pattern we have here. Most common is not 100% true, because we have some kind of statistics. This is the statistics for the impulsive move. Let's take this again. This is the impulsive move. And if you want to see how common are these corrective patterns here, you can see by statistics, zigzags are 1/3 of all corrective pattern, and you can add both of these, the zigzag and double zigzag pattern, which may they look quite similar on the first glance, and both together are nearly, let's say nearly 50%, depending a little bit on commodities. It's a little bit higher on stock market, it's a little bit lower, but you can see half of all corrective patterns are looking like this. Okay, so far the theoretical idea behind all this. Let's check the real market. How can we find situations like this in these markets? And I have some examples here from the Shanghai index. You can see, or from the Shanghai exchange, you can see the name is always written here. Sometimes I'm not able to pronounce it correctly. Please forgive me this, but you can also see the number here so that you can easily find these examples by yourself. And what you see here is some really similar situation here in a daily chart, for example. This is here the longest time frame, which is a weekly chart. This is a daily chart. This is a 4-hourly chart. So you can see sometimes more internal pattern here as well. But in this very moment, we focus on this daily chart here. So I bring it up a little bit. And you can clearly see we had something like a break roughly around here. We had a break roughly around here. And before that, it was strong to the upside. It was strong to the upside and strong to the upside. And putting all together, it looks roughly like this. And you may realize, this is quite similar what we're talking about here. 1, 2, 3, 4, 5. Coming back to the real life example, 1, 2, 3, 4, 5. Okay, understandable. Yes. So at that very point, we have a 5-wave cyclus behind us already. So the next should be some kind of a corrective pattern. And you may have still in mind, one kind of a corrective pattern is a typical A, B, C pattern. And if you want to keep this together, let's say this ABC pattern, this is nothing else than this ABC pattern here, which is quite typical. And if this ends there's a big chance that the market will continue into the same direction like we've seen before, the strong movement, the impulsive movement direction, which was in this case to the upper side. Let's see the real life example. This one was to the upper side. And so in this case, the market moved to the other side, which was the strong side here in the market. So we had an idea when seeing this one and realizing we have something like this. Some people simply say this is something like a bull flag. Maybe you have heard about this name already, which is also a little bit simpler in idea, but indicating that the strong movement should continue after the bull flag here is left, that the part of the bull flag is left. So that after some kind of movement like this, we need to continue to the upper side. This is really, really typical. And we can expect something like here, a pause, maybe here, maybe a pause, and maybe continuing a little bit more to the upside. So you can see this is something you can also see. This is a really nice example. Sometimes it's not so clear, but you see sometimes you have really nice examples of these trading situations. And if you realize these situations, then you have a good idea, I may trade this into the direction of the main trend. But sometimes it is too easy to keep it like this. So we need maybe some other details. For example, we need to know, okay, this is a strong movement. How far is this to the downside, and how long can we expect will the market continue into the direction, into the trend? And for this, there are some statistics. I don't want to bother you with too much details here, but I just want to give you an impression. We have some kind of statistics for all of these kind of movements. For example, we can see that the second wave, the corrective wave, has a certain area where it is really typical for the corrective pattern to reach. And after that, if the second movement is ready, how far will the third wave, the up movement, go after that? So we can compare, for example, here the third wave with the first wave to see how long it is. And you can see in this example, it is really typical that we see at least 100% or even more. Don't dig too deep for this very moment into this graphics here. Just realize we are talking about the area. This is not talking about the height of the chart here. You can see there are no numbers here. So it is just the probability. So you can see the gray area here is 20% probability. The last one is 20% probability, and the mid area is 60% of probability. That means that we can see that it's the same length. The third wave, same length, 100% the same like the first wave. We have a chance of roughly 80% that it's 100% or even more. You can see twice the length. It's not so, the probability is getting lower, because you can see here, or let's say 250% the length. It is still possible, but it's only less than 20% probable that this will occur. But it's really, really typical that we at least see 100%. So that's the reason why we can have an idea what we can expect here in this case. So if this is the first wave, we can measure the first wave here to the upside. And if this is the corrective pattern and this is done already, a typical target, not in any time, but a typical target would be around this area or even higher. So if you see some kind of a pattern like this, let's go a little bit backwards, and you see, okay, the market is ending this corrective pattern, we have a good idea that something similar like this will follow. So we have a first target and another chance that it will continue. But here the next decision will be made whether the market may turn to the downside. But we have a good idea, at least for something like a minimum target, how far we can go here in this case. So we can measure this. This is not only guessing. Just by statistics, we can think how far the movement will go. We have another important measurement, how far this drop is going down. And you can measure this as well with Fibonacci, starting from the lowest point to the highest point of the first movement. And you may have realized that we have a setback area. Let's go back to the statistics. Here you can see minimum, typical minimum 20%. But if you want to be on the sure side, it is quite good if you wait until the market at minimum is reaching this level, because then half of probability is gone already. So it is, for practical use, it's better to wait until the market is going beyond the 40 level or 38.2 Fibonacci level, but not too much, maybe not more, like a little bit more than 60. That's the reason why we can have an idea where the typical setback, if you have something like this movement and you're thinking, yeah, how far will we go down? Then you can think a typical setback would be somewhere here in this area. This would be a really typical setback. And now you can see, shall I buy now at that very point? No, because corrective patterns should be typically A, B, C patterns. So what I would expect is something like an A, B, C pattern. And only if this occurs, then it's a point to enter the market. And you can see that's exactly what the market was giving us. And to see, okay, after this, I can continue here to the upper side when this is over. And when do we know that this is over? A really simple way to answer this question, it's not the only way to answer this question, but a very simple way to answer this is, now we have falling highs and falling lows here. You can see high and lower high, low and lower low. But if this is broken, then the corrective pattern may have found an end already. So we can take something like this as an entry point. So we can clearly see where a typical correction normally ends. We can clearly understand where we can see this is some kind of an evidence that the market seems to turn. And we have an idea that what we've seen here is something like a minimum, a statistically typical target for the next movement to the upside. So we have a good idea to trade this level here to the upside. So this is, of course, only one example I've shown here. This is just here to give you an impression how we are looking at these situations. And I give you some others so that your eye is getting an idea how we can expect what the next movement is. For example, this here, in this stock, you can see that we have seen something like a strong movement to the upside. The market came from higher levels, and we have seen a low here. And in this case, let's do it like this, we've seen a quite strong movement to the upside. And I normally would expect that the market will have a setback into this area. So normally I would expect this is the area where I want to see the setback. And my typical trigger to look for the long side is the last high here, the ABC, the intermediate high here. So what did the market do? I was waiting. In this case, I would wait for the long entry. When the market is breaking this level, I would say, yes, now I'm in. But the market came down once more. This is still a corrective pattern. And we have a lower low here. So now we have the opportunity to change our entry, because this is the last low. This is the previous low. So now we can switch our entry to this high here, because we have two types of really typical and useful corrective pattern. One of it is this ABC pattern I was mentioning before. And the other one is looking a little bit different. It has something like overlapping corrective patterns. What is overlapping? What does it mean? In this case, it is a downwards trend, but you can see the counter movements here and here. They are sharing the same price. You can see this is lower than this one, so you can see in this area they are sharing the price. This is exactly what we see here. So this is classifying this part as a corrective pattern. So now we are waiting for a new entry point, and the market is going a little bit lower and lower and lower, and you can see now he's coming up a little bit and giving us a new low. And you can see the same idea like we've had before. This is the lowest point now, the second lowest point here. It is still somewhere in this trend situation. So we can say, okay, the entry point now is switching to this level here. As soon as the market is going through this level, the market came down a little bit more, but as soon as we switch to this level here, we can buy the market, to enter the market long, expecting that the market subsequently will reach somewhere around this level, or maybe even higher. It can be lower, it can be higher, but somewhere around this level. This is something we normally should expect, and it is roughly reaching this area. So sometimes maybe it's not perfect, maybe it's just a little bit below that. But as long as you can see that even now we have the 5-wave pattern to the upside and an ABC pattern to the downside, we still would suggest that the market is better on the buy side. Even if you don't like to trade exactly this trading idea with its entry points, target points, and we did not talk about stops so far, but with these trading ideas, you can see that the bullish side is still the better one. And also here you have something like a 5-wave pattern and now something like a corrective pattern. Maybe later we will get another chance to enter for another long position here as well. So you can see this is sometimes really simple, like in the first example. Sometimes you have some patterns which are inside a pattern and inside a pattern. You can choose whatever time frame you wish to trade. So you can see numerous examples. You can see this here, for example. This is 1, break, 2, 3, 4, 5, an ABC pattern here, and a continuation to the upside. So this is not a rare thing. So of course you cannot see this in all chart technical situations, but you can see it again and again, and you can see it in different time frames as well. For example, this chart pattern here and this one here, we would expect this here. And now let's have a closer look to this very end here. This is exactly what you see here in a 15-minute chart. So this part here, a little bit magnified in the 15-minute chart, is exactly this here. And you can see 1, 2, 3, 4, 5, a corrective pattern to the downside. And the expectation is that what we get here at the first part, we will see here at the second part again. So you can see this is not only in the daily chart. You can find these situations on nearly any time frame you want to trade. Also, if you're an intraday trader with stocks or the indices or currency, whatever, you will find these trading patterns as well. You can also find this, for example, with currencies. You can find similar situation, for example, in US dollar against the Chinese yuan. You can see this was a strong movement. This is a shaky movement to the downside, and the expectation that we continue here to higher grounds. And maybe now vice versa, we have here in a 5-minute chart something like this. We have something like an ABC pattern here, and if the market is breaking through the lower levels here, we can expect that the market will continue roughly same size like this as well. So you can see this is not only with the stock market, you can apply this to all liquid markets you want to trade. But keep in mind, chart technical analysis is always working best in liquid markets, not in low liquid markets. But the big currency pairs, for example, or the big stocks, they all have everything you need to trade this. So before giving you another example from the past, I want to show you that this is also working in the other direction. So for example, let's stick with this one. We have here something for the lower side. In this case here, I just show you the stock. Currently, the market participants do prefer the strong movement to the lower side, and the upper side is something like a corrective pattern. So I would expect that the market still needs to come lower a little bit. Maybe in the aftermath the market may raise. This may happen in the future, but currently this is definitely not a good buying opportunity. I would prefer to wait for a drop through this line, which is currently occurred, and expecting that the market will continue to the downside a little more. Roughly same size like here before. You can measure by yourself. You have a little bit of homework and expect what roughly will be the target for this movement in a typical way. Very important in my eyes is this is a typical situation. It is not in 100%. In any case, it's always happening like we were talking about. It is more like a typical, a statistically based idea that the market is normally going this way and normally going in this size. So we have a good idea in which direction we should trade. And if you are having a closer look at this part of the chart, you may have realized, isn't this looking like a 5-wave pattern? Let's switch to a 4-hourly chart. You can see first break, third break, fifth. There's no overlapping, by the way. The strong movement, the impulsive move, does not have any overlapping. So in this case, we realize this is a strong movement currently. If now the market is giving us something like an ABC pattern into this mid area here, I'm quite sure this is a good trading opportunity for the short side. I'm not aware this is coming now. I don't know this. How could I? I don't have a crystal ball and can see the future. But if the market participants are only coming up in a really weak way, something like this, I know I have an opportunity to sell short the market when breaking through these lower levels here. And this is perfectly fitting into the idea of the big picture in the daily chart. So maybe I can have this trade on a lower time frame and or on the bigger time frame. You can decide which is fitting better to your own trading strategies or your time schedule you want to invest into your trading ideas. So you can see this is a current idea how you can trade. I have something similar right now. You can see we have here this stock, we have a really good strong movements to the upside. What I would expect is something like coming back into this area. We've reached this area already. So what I expect is this is a strong one. It's not an ABC pattern. Maybe we get now an ABC pattern upside and then coming down once more. But this is not a negative signal. This is only, hey, I can get this stock cheaper in the near future maybe, because I can expect that the market will somehow continue this movement after this one. If the market is breaking this level, this is a really good buying opportunity, latest around this level. Or maybe if we see something on a lower time frame here, so we can enter on a lower time frame with the same pattern, with the same details here on a lower time frame. So you can see this is really working on many situations, and you also can use this as a filter. If you see some market is moving in a 3-wave pattern and breaking, you know long is not your option. You should still stick with the short side in this case. So you can, if you understand these kind of patterns and you see them in the market, even if you don't want to trade it exactly like this, but if you see that the market has a strong movement into one direction and something like a really ABC shaped pattern here, you can expect this will continue a little more. So this is something you can apply on all time frames, on all markets, whether you are long, whether you're short, so for rising prices or falling prices. or even to understand, can I wait for a little bit a cheaper opportunity? So maybe this might be a good trading opportunity. I'm not against it. I think this might be a good buying opportunity, but I would wait that the market will preferably coming down a little bit more and then buying, because this is a really strong indication. This part here is looking a little bit like this part here. And now we have seen this part and waiting for the second part, and then we can buy to get the next bull market here. So some people think, but I don't like to see that the market is falling. No. This is not a bad sign. This is only giving us an opportunity to get the prices cheaper and to get the stock on a lower price level. I hope this gave you a good idea what we are doing in the market, and that you can have a lot of input from this and use for your own trading strategies and building up or finalize whatever you like from these ideas for your own trading ideas. And if you wish, let's talk about this one. I'm looking forward to do so. So have a great time, big success in trading, and thank you and goodbye. 谢谢 and 再见.